Welcome back. If you like our training videos that we do from time to time, please don't forget to hit the subscribe button. That way you can actually catch all of our latest content that we put out on YouTube whenever we provide this learning content. Welcome back. On today's show, we're going to talk about the advantages and disadvantages of each classification of stock that you may purchase on the public stock market, or just in the general public. If you don't buy it directly, you may have someone who's a financial advisor who you buy through. The reason why it's important, because the first question before you actually buy anything is how much will you be investing over the next 12 months. So if you have $500 right now and you say that's all I'm going to invest, I need you to really take in consideration, you need to rethink that. And the reason is because opportunities present themselves throughout the course of the year, and based on what you're going to invest over the course of the year also allows you to see more opportunities. Think for a moment. If your 80-year-old self talks to you today, will it tell you to make his life easier or to make poor judgments and make your life harder? If you're like me, my 80-year-old version of myself is telling me, make my life easy. And that's exactly what you need to do for yourself. Make your life easy. How do we make your life easy? Is by thinking about this. What are the advantages and disadvantages of purchasing public stocks? Now, each different public stock that you buy has different classifications. So if we first deal with the most toughest question is how much am I starting with and how much would I invest each month? That for yourself. How come? Because opportunities present itself, and if you only have one entry, you're going to miss the next 11 months opportunities. So you don't want to do that. The second question is it worth deferring any pay to later down the road when you're older, or increasing your income now? The goal of investing is really to generate a cash flow, so deferring may be an option that you don't do now. Some people do defer. They don't want their income. Well, let's look at that for a minute. If you buy on the public market, either or through a financial advisor, any form of an IRA or a mutual fund. An IRA can buy mutual funds or can buy other stocks, but it's all deferment, which means it will not show up in 2021 or 2022 or 2023 or any 2020 year on your taxes currently. I mean, if you're going to deploy $1,000 and you can make $200 extra, do you really want to wait 20 years for that? I'm just asking a question. Do you want to wait 20 years from that? Waiting 20 years when you can actually receive it in a 12-month basis by receiving $50 every 90 days, and it also increase your overall income. So if you make $20,000, you now make $20,200. Well, if this is your goal to walk off your job, you now have $19,800 more to go, and you can walk off your job because $200 doesn't come from labor income. That's the advantage of not buying a mutual fund. Not saying that you don't have to, but understand that anytime you buy any fund that's a deferment or use any tax incentive that's a deferment, you are actually not making money this year. You are deferring money this year, and you can defer for multiple years. But that is not what the average person who is wealthy does. That is what common people do. So that's a common approach to investing. Well, let's look at the other two. Well, you have equity and you have preferred. Both of these stocks pay you in a 12-month basis. They're not a deferment. That meant in the next year when you file your taxes, it will show up. Now, you may say to yourself, well, I don't want to deal with taxes. Don't worry. If it's equity and you hold it more than 12 months, the maximum tax you receive on the money is on any dividend is 10%. That's the max. The max you receive on any preferred stock is 10%. That's the max. So it's not an issue where it's going to cost you more. Labor can start off easily at 12%. So both of those stocks in a 12-month basis is cheaper than you actually getting a second job. So that should not be your concern. And if taxes make you nervous, then I'll tell you then you need to take a step back and say this. Oh, that's an area I need to be educated, because he just stated that the maximum I can get hit on in taxes is 10%. Now, let me just tell you, I'm not an accountant, in case you want to know. I'm an entrepreneur that's an investor and a talk show host. But what I can tell you is this. If you hold a stock over 12 months, hit the Google button and ask the question for yourself. Research, remove the fear, get the answer so you actually know that it's 10%. some tax codes tell you that unless you make more than 20,000, taxes are really zero on dividends. But don't take my word for it. That's what accountants are for. Make sure you seek out and talk to an accountant. What you will see before you talk to one is Google it. Google is a great opportunity. I don't get paid by Google, but I'm just telling you, because sometimes we can minimize fear by getting informed. Now let's get back. When you're looking at a position and you're thinking about buying a stock, we have already addressed the issue of how much you're going to invest. Second, you now know that each month you're going to be adding money to your assets under management. So you started off with $500, you added $50 the next month. So now you have $550 under management. All assets under management, whether it's yours or someone you pay, means the money that you put in their hands or you hold in yours, and it accumulates over a 12-month. And then it begins to compound each year as you go forward. That's the assets under management. The first time anyone has any assets under management is the money that you have in your savings account. So your savings is your money called assets under management, but it's not an investment account. So when you're thinking about purchasing stock, let's look at how it allows you to take advantage. If you buy equity, the question is, am I buying equity that doesn't pay a dividend, or am I buying equity that pays a dividend? If you're starting off in investing, think of it this way. Can you afford to work a job and not get paid? Can you? I don't choose to invest in anything if I can't get paid in a 12-month basis. Now, down the road, when I'm getting paid from any position that I purchase, which has an equity association as far as the classification of a share, then I can take full advantage of buying stock that doesn't pay equity. But until you learn some little bit more of strategies to overlay over just buying stocks that don't pay dividends, then you need to just say, if I buy a business and I become a co-owner in a fractional standpoint, because that's what equity is. Equity is an opportunity for you to share in ownership of this business in a fractional amount. Each share that you buy is one fraction of the overall total number of shares. You own 100% of all the shares, you're 100% owner. And so you buy it in fractions. That's the one thing about the real world when it comes to investing. Everything's in fractions, not whole parts. Like someone that's your friend that starts a business. He owns 100%. But when you buy on the public stock market, you buy one share, two, or three. But does equity fit your overall goal? Let's say, for example, you are not interested in owning a company. So equity doesn't fit into your category. But you'll say, well, I don't want to own any equity because I don't want to own a business. Well, maybe you look at a preferred stock. If you buy a preferred stock, then that means you take claim to those owners or those entrepreneurs and the rest of those stockholders in that company. You hold claims on the debt. Now, you may receive a pay either monthly, quarterly, semi-annually, or yearly. But no matter what, you're getting paid because preferred stock doesn't have equity. You have no right to say what goes on in the company or have a vote, but you do hold the assets. Whatever those assets are, you put a claim on those assets for the amount of money that you actually invested. And if you invested $1,000, you have $1,000 on the claims of the asset of that company, and they're going to pay you a fee. What does that mean? It means you gave your first loan out. So does loans fit into your overall goal for investing? In a 12-month basis, you will get a paycheck from the loan obligation. It's called a premium or a coupon payment. So you're now receiving that over a course of a 12-month period, and now you're able to make payments. How does that affect your overall income? Well, if you make $20,000 and your payment on your preferred stock, your coupon payment happens to be $20 every 90 days, well, now you make $20,080. $20,000 from labor income, $80,000 from coupon payments from your preferred stock that you have. Well, what if buying debt or placing debt on companies by lending money is not an option for buying preferred stock, and you don't want equity, which means you don't want to be a co-owner and receive money from the products or services that that company offers, and after they pay everything, the net income? Then you look at buying a mutual fund. It's not preferred stock, and it sure is not buying debt, because neither one of those things are available to a mutual fund. It's just profits and distributions. Out of all these three shares, a mutual fund does not allow you to have a say-so or to not take claims on debts. Now, here's an interesting notion. It is one of the things that is found in everyone's 401k plan, but they don't own the business. I hear most people make statements like, oh, I own Apple stock in my 401k. Honestly, you don't. How come you don't? Because mutual funds are really classified as profit and distribution only. In order to own Apple, you have to have equity, and 401ks don't offer equity. Unfortunately, they just don't offer equity. So you have a profit and distribution share in your 401k plan that you can receive only if it pays a dividend and capital appreciation from the mutual fund company that actually owns the equity. So you buy the mutual fund company stock, the mutual fund company buys Apple, and in their company portfolio, you see it show up on your statement, but you don't own equity. You just only receive profits and distribution. How come? Because they actually are the fiduciaries and they actually own the equity. You don't own it. How does that fit in your portfolio? Well, in a 12-month basis, it doesn't show up on a W-2. You defer it down the road until you hit the age of retirement, 59 and a half, or if you decide to retire at 65 or 72. From these three categories today that we talked about, two of them benefit you on a 12-month basis, equity and preferred. They will show up in your next following year taxes, but your income went up. Your financial advisor or your accountant on those terms. Today, I just want to make sure you understand that a mutual fund does not pay you on a 12-month basis, but equity and preferred stock does. It impacts by giving you a raise without having to wait for your employer to give you one. Until next time, just remember, know the differences between these three stocks: equity, preferred stock, and mutual funds. There's advantage to buy two, and there's a deferment on the last one. Have a great day.